Welcome to the latest investment update with Chief Investment Officer Gary Reynolds. I'm going to be talking to Gary about markets throughout the year, Courtiers Fund performance, investment strategies and stock selections, and finally, what Gary's views are on the state of the UK economy right now. Gary, hi, markets, what are you seeing?
Well, it's been a pretty bloody year so far, Leo. The recovery of long-dated bond yields has started to actually happen, something we've been forecasting for a few years. So that's had a devastating effect on the price of long-dated gilts, which are off nearly 26% so far in 2022. And other markets off as well. NASDAQ, which is sort of the US index of sort of tech and growth companies, is off over 30%. The S&P 500, represented the broader markets, off 21%. FTSE mid-caps off about 18%. And the FTSE's actually been one of the best markets, which has been a big change from previous years, because since, coincidental, from June 2016, when the country voted for Brexit, the FTSE has underperformed most other world markets, but it's actually had a much better year. And that's probably because it's got a lot of banks and materials and energy companies in it rather than tech companies. So it's been a really, really difficult year for investors so far.
Turning to the Courtiers funds, how have they been faring for clients?
Well, they've done a lot better than those figures I've given you, with the exception of FTSE. A growth fund, which is sort of 100% invested in generally in real assets, it's not designed to be defensive, is off just over 8%, which compared to the MSCI World Index, which is off about 21%, is outstanding. Now, let me just qualify that, Leo, that our long-term investors know that the price they pay for above average returns over and returns in excess of cash and safer assets is volatility. So we cannot shield them from short-term volatility, but what we try to do is make sure in the long run they'll hit their objectives. So when you get a fall in markets like this, and we fall significantly less, I'm naturally pleased, but I'm also mindful about the fact that people are looking at their portfolio values today on the 14th of June compared to what they were on the 1st of January. They are down. If they're holding cautious multi-asset fund, just over 3%, balanced, just under 6%, and growth, just over 8% off. So overall, relative to some mighty big numbers, and particularly with the so-called safe UK gilts off nearly 26%, those figures are impressive.
Courtiers talks about building wealth, protecting wealth, enjoying wealth and passing on wealth. It sounds to me like protecting wealth is very much what you and the team have been focused on throughout the year. Now, if that's the case, Gary, what's influencing your investment strategies and your stock selection right now?
Well, it's very much a case of looking for things that you consider are reasonable investments. Let's use UK companies or global companies as an example. You want companies to buy into companies that are reasonable companies, well run, have got decent balance sheets so they can withstand any difficult times, and are also being priced at what looks reasonable, consider their long-term prospects. So you get a margin of safety. Generally, when you're buying these stocks, you're buying them at price earnings ratios that are less than the market average. Now, I'll give you an example on this. If we look at the S&P 500, it's been trading above 20 times earnings. So, whatever that means it's valued at 20 times its profits. It's below that slightly now, which is into more normal territory. Around 17 to 18 would be a reasonable long-term multiplier of profits. But sometimes it drops down a lot lower. But if you look at that price earnings ratio on the world's biggest market as indicative, we have got a basket of UK equities in our UK equity income fund. They're trading on the historic price earnings ratio of 8.7 forward, i.e. on the projected next year profits about 8.2. So our assets that we've got, that we're holding in equities, are generally on a much better value metrics than the big indices at the moment, and that for us has been deliberate. We have not been holding long dated gilts, which is why Cautious and Balanced have done so extremely well compared to their peer groups. They've not been taking hits in their bond allocations. I guess longer term, we've got to decide when it's right to start building up on exposure to bonds again. But we're not rushing back because inflation figures are still high, and all the predictions are that the central banks will increase interest rates a bit further. So these are difficult times to navigate. It's certainly, you just have to be a bit careful on everything you're doing at the moment. And because the markets are so volatile, it's not possible to buy put options to defend the downside in the portfolios, because you're being charged a fortune for them. And so yeah, they're difficult times, and we're just trying to take it day by day, do our research. But if I compare it, Leo, to what it was like if you compare to what we were doing in the summer of 2020, where we were simply looking at loads of great opportunities, the market today has got opportunities, but there are also, I think, lots of businesses that are not going to justify their very high valuations in the long term, and clearly you don't want to be invested in those.
Gary, thank you very much for the insight there. And just to close, your views on the UK economy right now, please.
Well, it is difficult because if you look both sides of the Atlantic, unemployment figures are at really low levels, which is extremely positive. But growth is difficult, and we've got an increase in inflation. So that's bothering the central banks. They are likely to go on increasing. I think there'll be a tendency for the Bank of England not want to get caught behind the curve. So I expect we will get more interest rate increases, notwithstanding they could be being made into a weakening economic environment. My own view is that you're not going to get a big recession. I think what's happening is we've had to deal with an adjustment where the swings in the quarterly fortunes of the global economy were massive through 2020. It had huge disruption to supply chains, and then the tensions between US and China aggravated those supply chain disruptions, and then the war in Ukraine has aggravated them further and caused a big increase in commodity prices. So that's not great for the economy, and it's going to be a tough time. But I wouldn't be a huge doomster on this, because I think you've got to see what happens as the economies begin to get back to normal post-COVID. And they've got to deal with the wild variations through 2020 and 2021, variations like we've not seen for 300 years, and then try and get back to something like normal. So you can't really look at recent movements in economies, say over the last 100 years or so, to get an indication of what that's going to be like, because we haven't experienced a pandemic like this in modern economic times. But I am a bit more optimistic. I think there are lots of very, very positive things going to happen in the world economy going forward. And I think we're going into a new period of a big revolution, and that revolution will be in creating green energy, i.e. energy that doesn't pollute or damage our environment. And that is going to create tremendous opportunities for lots of businesses, and directly and indirectly. And I think you have to be mindful of that when you're making your selections.
Gary, thank you very much. Gary Reynolds, Chief Investment Officer. If you do have any questions for us, please do contact your advisor or contact us through the website, and we'll be happy to get those answered for you. Thanks again.